I'd like to introduce our moderator, Brendan Walsh. Brendan is the CSH tax leader and a shareholder who specializes in tax consulting for businesses and their owners. His work focuses on strategic tax planning to minimize tax exposure, specializing in fixed asset strategies, depreciation, cost segregation, and tangible property regulations in the construction and real estate industries. Brendan has worked with companies ranging from startups to billion-dollar publicly traded entities. I will pass it off to Brendan to introduce our presenters and kick things off.
Great. Thank you, Allie. Welcome, everyone, and good afternoon. And again, my name is Brendan Walsh, and it's a pleasure to speak with you today. I want to first thank you all for joining us and welcome you to the second of our two year-end tax planning webinars. Hopefully, some of you were able to attend the first of those webinars, which focused on individual planning strategies, which we held a few weeks ago. But of course, today's webinar focuses on year-end tax planning for businesses. So we have three presenters with us here today. Zach Gubser is a tax shareholder who works on compliance, planning, transaction, and controversy projects for clients ranging from individuals to pass-throughs to large multinational corporations. Zach has a wide array of industry knowledge and a great deal of experience working with manufacturers and service companies. Zach focuses on strategic planning opportunities and minimizing tax exposure for his clients. Brittany Lawrence is a tax shareholder who focuses on business tax planning and compliance. In addition to multi-state experience, Brittany's industry focuses include real estate and manufacturing. She helps clients fulfill compliance requirements of the various taxing authorities while minimizing tax implications and providing valuable tax planning strategies, including multi-tiered partnerships and Section 1031 like-kind exchanges. Brittany works frequently with the IRS and the state of Ohio, resolving conflicts and assisting clients with audits. Our third speaker is Phil Hurak. Phil is a managing shareholder of Clark Schaefer Consulting and the leader of the state and local tax practice here at Clark Schaefer. Phil thrives on change and leveraging it as an opportunity to create value and minimize risk for clients. Throughout his career, Phil has used his legal, business, and consulting expertise to deliver measurable results for businesses from family enterprises to Fortune 500 clients. So I will go ahead and talk through the agenda for today. First, we are going to give a quick legislative update and then provide just a brief refresher on what the individual and corporate tax rates are. And then the bulk of our presentation is going to be on our top 10 planning considerations for businesses for 2025. If we have some time, of course, we are restricted. We only have 60 minutes here, so we'll get through as much content as we can. But if we do have time, we will touch on some additional considerations and then finish up with a reminder on some resources that are available, upcoming events, and then any questions that you all might have. So with that, we have our first polling question. And again, just a reminder, you can go ahead and answer at least 3 out of the 4 polling questions if you would like to receive CPE credit for today's webinar. While you're looking at that, I will go ahead and pass it off to Zach Gubser to talk through a legislative update. Zach.
Thanks, Brendan. This being a tax webinar in 2025, the starting point has to be the One Big Beautiful Bill Act. This was the law. It was signed into law on July 4th by President Trump, but it's the most impactful piece of tax legislation we've seen over a number of years. Probably back to President Trump's first term when we saw the Tax Cuts and Jobs Act in 2017. It was very impactful, and I think not because of what it did, but what it prevented from happening. We're not going to go into all the details of whether you call it the OBBBA or OB3 or however you want to term it. We're not going to go into all those details today. We did do some webinars over the summer. Those are archived on the website. So if you want those details, certainly you can find those webinars, but today we're going to focus a little bit more on just, other year-end opportunities. But for OB3 specifically, as I mentioned, back in 2017, we got some radical changes to the tax code, whether that was in the form of Section 199A. We got huge cuts in the corporate tax rates. It was new concepts introduced into the code. What we saw with OB3 was an extension of some of those provisions that were set to expire. So in 2017, when they passed TCJA, they had to sunset some of the provisions, some of the cuts for the taxpayers in order to pay for the bill. A lot of that was set to happen and set to expire at the end of 2025. So absent any changes at the end of 2025, the qualified business income deduction was going away, bonus depreciation was going to fully phase out, but taxpayers were going to be significantly impacted. What Congress did is they passed the One Big Beautiful Bill Act. They extended a lot of the provisions that were going to expire, and they made them, quote unquote, permanent. So when we say permanent, we just mean they are not set to expire. The legislature could always change the law, but absent legislative change, these provisions aren't going to expire. So again, not going to go into all the details of the bill today, but suffice it to say, at the margins, some taxpayers are going to see some new significant benefits, potentially some manufacturing entities, potentially some small businesses with, if they're a qualified small business, but, we're just going to cover some planning opportunities. But besides OB3, what have we seen? Immediately after OB3 was passed, there was potential for some additional reconciliation bills. None of that has come to pass. There were some, I guess you could view them as mistakes in OB3. Maybe the Republicans didn't know exactly what was in the bill or some things that they passed. So there was talk of fixing some of the gambling limitations, some other things that were in there when it was passed, but we've not seen any additional reconciliation bills. So late summer, early fall, we thought we may get some additional tax legislation. Then you continue through the fall into the winter, government shuts down, over the funding debate, finally get a bill passed that extends, funds the government through January 30th. But other than that, haven't seen much federal legislation. Now the entire focus is on Affordable Care Act subsidies, National Defense Authorization Act, other things that aren't really tax related. So from a federal standpoint, while we thought we may see some additional tax legislation, we haven't. So where have we seen a little bit more movement? States and localities. So the states, they can either conform to some of the changes that we saw with OB3. They could decide not to conform to some of those changes. But either way, we have seen some movement amongst the states, whether it's related to OB3 or whether they're making their own legislative and tax changes. We've also seen some additional guidance from the IRS. Congress passes the law. The IRS, being the regulatory agency, has to pass, explain some of the law and, really some of the nuance. So we've gotten a little bit more guidance on how some of these provisions are going to operate. There's still a lot of unknowns. There's still a lot we need to know. The IRS did issue their priority guidance plan, which is, 40 plus of those items are OB3 related. There's certainly a laundry list of more items in that priority guidance plan. But what that is, that's just where the IRS intends to focus their resources over the coming year. So we do expect to see more guidance. We are hamstrung a little bit by the government shutdown we saw in the winter. There's always the potential that we have another government shutdown when this funding round runs out. And then we're also battling, or the IRS is battling uphill a little bit with the directive that, for each new piece of guidance or, new regulation, 10 regulations have to be eliminated. So definitely something we'll be watching. You'll see content come out from us. You'll see communications. But, most impactful piece of everything we've seen this year is OB3. So moving to the next two slides, these are just the individual tax rates and corporate tax rates over 20 or for 2025 tax year and for 2026. We're not going to cover those in detail. Just they're there for your reference. So now diving in to the heart of the matter. So moving on to the qualified business income deduction. This is one of the provisions that came about in 2017 with the Tax Cuts and Jobs Act. The corporate tax rate, if you recall, it used to be in the 30s, mid 30%. They dropped it down to 21% back in 2017. Now, to maintain some rate parity, they also created a new deduction, and that was the Section 199A qualified business income deduction. So what is that deduction? Subject to some limitations and phase outs, it allows the owners of certain pass-through entities to deduct 20% of the income that is passed through to them from that pass-through entity. If you're brand new to Section 199A or pass-through entity ownership, I suggest you reach out to a tax advisor. We're not going to cover all of the nuances today. But for those of you who've been operating pass-through entities, what should you be thinking about as we near the end of the year? So moving to the next slide, the QBI deduction at the pass-through entity level, or at the pass-through owner level, it may be limited based on the W-2 wages that the entity is paying to employees. There's also another limitation. It's based on W-2 wages plus what the capital assets on the balance sheet. So if you are a pass-through entity, what are some things you should be thinking about going into year end to maximize your potential deduction? Are there bonuses or compensation payouts that you were going to pay anyway? I mean, we're certainly not going to suggest that you're incurring expenses or just spending money so you can save some taxes, but are there bonuses that you were going to pay out anyway, and maybe it makes sense to accelerate those bonuses and those deductions into the 2025 tax year? That bumps up the wage threshold and bumps up the cap on the 20% QBI deduction. For SSTB owners, again, specified service trades or businesses are generally not qualified for the 20% deduction. But if you are below certain AGI thresholds, you may qualify. So if you own a specified service trade or business, you're an accountant, attorney, some other listed businesses, maybe it would help if there are ways you could reduce your AGI to then maximize the deductions. Now, again, I'm not going to tell you to forego income just to avoid tax, but sometimes if you can time that income, maybe you can push some things off into the next year. But the lower you can get your AGI, the better it's going to be for the specified service trades or businesses. And W-2 wages are going to help you out from a deduction capacity standpoint. So moving on then to discussion of the 163J business interest limitation. Again, something we saw with TCJA in 2017. This is a limitation on the ability of taxpayers to deduct the business interest expense that they incur during the year. When this was introduced back in 2017, the limitation was essentially 30% of your EBITDA. So, if you add depreciation and amortization back to your earnings, you're going to get a bigger number. 30% of a bigger number is, obviously higher than 30% of a smaller number. So it's that cap. We wanted the cap to be as big as possible. And that cap gave you some capacity to deduct your business interest. Now, over the years since TCJA, the definition of your taxable income, adjusted taxable income, it dropped to EBIT. So earnings before interest and taxes, you are not adding back depreciation and amortization. So that becomes a lower number. And that 30% of that lower number is a lower cap on your ability to deduct business interest. So over the past few years, as interest rates have been rising, we've also been seeing more of a limitation on the ability of taxpayers to deduct that interest. Now, with OB3, that calculation changed back to EBITDA. So now you're going forward, you're able to add back the depreciation and amortization, really increase your cap, which increases your ability to deduct business interest. So what should taxpayers be looking at now as we move on to the next slide? Review your capital structure. Just does your debt to equity ratio still make sense? You determine whether previously suspended losses or previously suspended interest may now be deductible, and you can update your tax estimates accordingly. So for a lot of taxpayers that have suspended interest from prior years, if they were subject to those limitations, if a lot of their expenses were depreciation and amortization, now going in to 25 and forward, they may have some excess taxable income now that's going to pass out and release those carry forwards for deductibility in the current year. So, we're now going to be able to reduce taxable income, which hopefully can, make you reduce your tax estimates, hold on to a little bit more cash, invest that in the business. There's some interest capitalization rules. If you've heard of those, or if you're aware of those, we're not going to go into all of those details today. There were some changes in OB3 to your, if you were capitalizing interest into inventory or cost of goods sold, they did make some changes. Lastly, if you're a real estate business, there are elections you can make to opt out of the 163J limitations, but there's a little bit of a push and pull. The depreciation lives change a little bit. There's some limitations on your ability to make that election. So if you are a real estate entity, if you are suffering some limitations on your ability to deduct interest, there could be some relief you can get just by making a certain election. So what are we going to talk about next? Section 1202. This is another area we saw some changes under OB3. It would be remiss if we didn't discuss it, but this is, it's going to be applicable to a certain small subset of taxpayers. And we don't have time today to go through all those details, but generally speaking, Section 1202, it allows taxpayers to exclude the gain from the sale of qualified small business stock. And, it's for eligible taxpayers subject to certain limitations. Those are defined terms that are pretty important, but the provision's been around since 1993. There's been some changes over the years, but importantly, OB3, it shortened the holding period to qualify for the exclusion. Prior to OB3, you had to hold the stock for 5 years to get 100% exclusion. Now they've shortened the holding period to a 3-year hold period that qualifies for a 50% exclusion, 4 years for 75, 100 or 5-year hold period will get you 100% of the exclusion if you qualify under all the other provisions. But 3 years is a lot shorter than 5 years when we're talking about selling a business and the holding period. The OB3, it also increased the limits on what does qualify as a small business. So prior to OB3, the cap was $50 million of, just call it enterprise value. Post OB3, that's $75 million. Prior to OB3, the cap was $10 million of exclusion, or 10 times your basis. They've bumped that up to $15 million. Now that $75 million small business threshold, that $15 million excludable gain, those are both inflation indexed going forward. Still a lot of unanswered questions regarding 1202 in some of the nuance and how it operates. But if you are a small business, if you do anticipate rapid, future growth, then this may be something that you want to talk to your advisors about. So with that, I believe we're going to get into our second poll question.
Yes, and just as a reminder, if you are interested in CPE credit, please answer 3 out of the 4 polling questions that pop up throughout the discussion today. And while you are answering that polling question, I will turn it over to Phil Hurak to discuss the pass-through entity tax. Phil?
Great. Thank you, Brendan, and good afternoon. As we've seen continued change through the pass-through entity tax, recall that this initially the PTET initially came about as a result of the $10,000 SALT cap at the individual level. So OB3 has provided some level of relief to the SALT cap, raising that to $40,000 in 2025, subject to phase outs beginning at 500,000 and ending at 600,000. So a very narrow window. So for pass-through entity owners that are below $500,000, it may be more advantageous to take that $40,000 deduction versus via PTET. Now, of course, there is no SALT tax limitation for pass-through entities, thereby requiring that analysis. So as we think about how do you plan around PTET? It is certainly a strategy, and it's especially a strategy for those pass-through owners with AGI above $600,000. Below that, it's a evaluation and calculation. We've seen some clients consider entity planning to take advantage. So looking at Schedule C conversions in order to get the benefit of PTET and not be subject to the limitation. And then, of course, going back to Zach's slides, it is important to monitor the play between the QBI and the SALT phase out. So lots of moving pieces, but the point here is PTET is certainly a strategy. It is still in place at many of the state levels, and something to look at to drive federal savings by paying the tax at the entity level as opposed to the individual level. The next area of planning in consideration for end of 25 here and going into 2026 is we continue to see states expand definitions of nexus and how they look at income and activities within states to drive revenue to those states, to drive, of course, taxation by the state taxing authorities. Concepts of economic nexus, so looking at sales base, as we have seen in sales and use, are certainly in the world of income tax, or entering into the world of income tax nexus today. Looking at how companies source or mandating certain market-based sourcing to drive revenue into a specific state. We're also seeing a continued attack or narrowing of 86-272 protection that has historically provided a blocker to businesses to not have to file in a state because they were falling under the 86-272 protections. Many states are attacking this via online activity or cookies via websites or some activities of how you are selling into a jurisdiction. So just because in the past you've had a successful 86-272 does not mean that it would necessarily be protected in the future. And then we continue to see the aftermath of COVID with continued hybrid and remote workforces, having individuals working across the country in different states, including 1099 contractors. Many clients will say, well, they're supporting the home state activities, and we're not selling into these jurisdictions. Unfortunately, many times, just the mere presence of that W-2 employee in a certain jurisdiction can give rise to physical presence nexus in a state. So what companies should evaluate, particularly if their situation has changed, be it in the states that they're selling into, how they're selling into them, and or where certainly employees, contractors, equipment inventory, if any of those are operating in new jurisdictions in the year, it's probably makes sense to evaluate Nexus study to identify any new filing obligations. Even if you decide to not file in that jurisdiction, to at least understand the risk, because much like federal, if you do not file, that statute of limitation does not start to run. So understanding what the risk that you are bypassing on makes sense. If you do decide to file, a strategy around voluntary disclosures can also make sense. It can help limit not only the look back, but also limit the amount of potential penalties paid for paying those taxes in arrears. It's also important to track these changes in state sourcing and state revenue thresholds. These continue to change. States will put out a notice, and that from then on will be the new line in the sand. We've seen clients get caught up in this, thinking that they were operating under old rules. Rules have changed, and now they have a filing responsibility. So, and then finally, understanding where you are delivering, where is your product going to, because in these audits and working with states, many of the auditors will want to see documentation, clear documentation around where and how a product is flowing to different jurisdictions. So continued expansion around state nexus. States are hungry for revenue dollars and certainly seeking to source those dollars from, especially from businesses that are not directly operating within the state. And then the third area that I'm going to talk about today is research and development. OB3 restored the expensing of R&D cost in 25 via 174 Cap A, which previously required a 5-year amortization. So this is good news for those of you that have been claiming R&D, but dealing with the pain of the amortization, not only the pain of tracking, but also the inability to take that immediate expensing. So certainly a positive for manufacturers, tech companies, other businesses that are claiming R&D, a big benefit there. The IRS has tightened the documentation and reporting requirement to claim R&D, to provide additional information on the face of the tax return around QREs and the specific business components. This is probably just good practice to ideally long-term limit or alleviate some level of audit around R&D, but instead of just putting a number, there's some level of substantiation on that on the tax return to help direct the service that truly this is R&D. Also, keep in mind that state R&D credits continue to be out there. Certainly, I know across the footprint of participants on this call, we've got R&D credits across all the states here, certainly that Clark Schaefer operates. One to note is Michigan is launching or has launched a new R&D credit effective in 2025. So something to look at. And if you have not looked at R&D in the past, something to look at. And I think that the state component can add additional fuel to that fire. As we look at the planning tips around R&D, with the change under OB3, there's certain small businesses that can amend and go back and get refunds for 2022 to 2024, converting that R&D amortization. And so something to look at if cash is retroactive cash is something that is of interest. Otherwise, this can be claimed in the 25 and 26 years. We are looking at higher IRS scrutiny on the credit, and IRS seeking and requiring more contemporaneous documentation. So, we've seen some clients take a strategy of trying to do R&D evaluations throughout the years on the projects and document them while it's happening or at the conclusion of an R&D project, as opposed to waiting until the entire year wraps up and completing a study for all projects at that time. We're also seeing, certainly as I mentioned, from a state standpoint, evaluating the state piggybacks, as in Michigan and Ohio, and/or it's not a direct piggyback in Kentucky, but some of the related R&D credits like we have in Kentucky. It just makes sense, in addition to the federal, to not overlook those state level benefits. And for those businesses that have not taken an R&D credit in the past, or potentially looked at it in the past and passed, and or ceased to take it because either, and we've seen both these situations, where R&D expenses have been going down, thus rendering a credit not as valuable due to base period calculations, and or because, and we've heard some clients echo the hassle around 174 amortization. 2025, 2026 may be a good time and year to reevaluate R&D to determine if in fact it is something to pick back up, given the immediate expensing from 174 Cap A, as well as the Section 41 tax credit. With that, I will turn it back over, Brendan, to our next poll question.
Yeah, thanks, Phil. Yep. Poll question number 3 here, everyone. So please go ahead and answer that if you're interested in CPE credit. And next, Brittany Lawrence will be discussing capital asset planning. Brittany.
Yeah, thanks, Brendan. So consider continuing on here with our top 10 lists. Next up is number 7. So the next few slides, I'm going to focus on capital asset planning. And this is really a tried and true tax planning strategy for many companies that wish to accelerate their tax deduction. So bonus depreciation, it's been around for as long as I can remember, varying percentages through the years. An OB3 law has made a quote unquote permanent change back to 100% for assets acquired as well as placed in service after January 19th, 2025. And this is kind of a magic date that comes up a couple of times in the new law. So essentially that means if the asset was acquired and placed in service on inauguration day or after, then 100% bonus is going to apply. And under the prior law, keep in mind that the deduction was 40% for 2025. In terms of what qualifies, all the same rules apply here in terms of what is eligible for bonus. The property must be personal property with less than a 20-year life, and it can be new or used. And also keep in mind that bonus can be used if your business is in an overall loss situation. So again, this has been a really pro-taxpayer change back to 100%, as we had been dealing with this phase down of bonus since back in 23. And I know many tax professionals and companies had been anxiously waiting for this change back to 100% for some time now. And also the permanency of the change should allow for better long-range planning, as it gives some, certainty as to the rate that we have for bonus depreciation. So again, bonus is one of the great ways to accelerate tax depreciation when your company is investing in CapEx, and then ultimately use that deduction to decrease tax exposure and increase cash flow for your business. Continuing on this slide here, Section 179, if we could go back a slide. Thank you. Section 179 is another strategy to consider when you want to pull in tax deductions into 25 by accelerating tax depreciation. The new law has increased that limit to $2.5 million for 25. And it was slated to be 1.25 million for 25. So OB3 gave us basically double of the prior 179 limit. OB3 also increased that phase out limit to 4 million. So if you acquire more than 4 million of qualifying property in 25, your Section 179 deduction will begin to phase out. And then in 2026 and forward, all of those thresholds will be adjusted for inflation. A couple things to keep in mind with 179, it's a little bit different than bonus in that you still get to write off the full amount of the cost of the qualifying purchases, such as equipment and machinery, but you must have taxable income. So in other words, Section 179 cannot take your business into a loss. And then also, typically, if you have trust owners, there will be some limitations on the amount that trust owner can take. Continuing on with this topic on the next slide, cost segregation study. The increase of bonus depreciation back to 100%, we are seeing has significantly increased the benefit of a cost seg study for real estate. So you will definitely want to consider that if you acquire or rehab a building. And basically, cost seg is a technique to essentially accelerate tax deductions relative to a building into an earlier year by allocating part of that cost to shorter lived assets. And many of those shorter lived assets are going to qualify for accelerated tax depreciation. And this is really helpful due to the time value of money, again, in getting those deductions earlier. Ultimately reducing the impact of cash going out the door for taxes. It applies to both residential as well as commercial property, especially good for new acquisitions or substantial renovations. Best practice is to do that cost seg in the year of acquisition, but it can be done in the following year as well. And a little side note, CSH does have a dedicated group for doing cost seg studies led by Brendan Walsh, so contact us if there is a need. The next slide is going to cover qualified production property, or QPP for short. This was new as part of the OB3 law back in July, and it essentially introduces a 100% deduction for qualified production property, which is going to include 39-year property. And this was essentially, as I said, a new section within bonus depreciation section of the code. QPP is generally going to be non-residential real property and has to be used in manufacturing, agriculture, or chemical production. So a couple of key dates to keep in mind. Construction must begin after January 19th of 25. So again, that magic date comes up again. It must be placed in service after July 4th of 25, which was the date of the enactment of OB3, but before 2031. So those are important dates to keep in mind if you have that within your business. Couple important details about QPP. It must be used by a taxpayer as an integral part of qualified production activities. So things like offices related to sales functions, administrative spaces, anything not directly used for production is not going to qualify for QPP. It also must be placed in service within the United States and original use with the taxpayer. And then there also is a clawback, a recapture provision if during the 10-year time period, the building ceases to be used in a qualified production activity. There is a recapture provision. So again, this was another pro-taxpayer, pro-United States change as a result of OB3. Several details are still to be clarified either by technical correction or IRS guidance. But it does create a really important incentive for taxpayers to expand or develop new manufacturing properties within the United States, as there is really going to be a significant financial impact of that 100% bonus when compared to the deduction under a 39-year straight line method on the building, which would have applied prior to QPP being available. So on the next slide, a couple of capital asset planning tips as we wrap up this one. Ensure you've met that magic date for 100% bonus. You'll want to project out your capital asset depreciation using that multi-year plan, again, since we have some certainty with regard to the rate for bonus. You will also want to watch out for state decoupling because many states are not going to allow the same incentive for a bonus in 179 at the state level as you will get at the federal level. So you'll make sure you watch out for that as well. Also look out for any impact from business loss limitations that might come into play with a loss that's generated by bonus depreciation, for example. And also make sure that you're taking a look at QPP if you're building a manufacturing facility. And also note that these rules are very complex. So make sure you're discussing this with your CFO advisor so you can make sure you're getting all the incentives that you can. Next up, the next slide, we will talk about pass-through entity considerations, number 8 on our top 10. Basis limitations and passive activity limitations. So this could be a potential gotcha moment for some clients when their business has experienced losses in 25, either because of accelerated tax deductions that we talked about previously, or perhaps a decline in revenue. And those taxpayers may be expecting those losses to offset other types of income, such as wages. It's important to keep in mind that owners can only write off losses to the extent of basis. And there are several levels that you must clear before writing off those losses on your individual tax return. Those include tax basis, at-risk basis, as well as passive activity limitations if you happen to not be active in the business. So if you're in this situation, it would be a good idea to touch base with your tax advisor, model it out before year end to see if there's any planning that can be done, such as a loan or a contribution to the entity, or intentionally triggering some passive income to offset those losses. Continuing on with this, number 8 on the next slide, excess business loss limitations under 461. This was an additional hurdle that was created back in 2017 as a result of Tax Cuts and Jobs as it relates to the deductibility of business losses. And what TCJA did basically was create a limit on the amount that an individual can deduct for business losses. And in 25, that threshold is $313,000 for single taxpayers and $626,000 for joint filers. If you get caught up in this limitation, those disallowed losses are generally going to be carried forward as a net operating loss to the next tax year and can be credited against other types of income in the following year of the EBL limitation. So a couple of planning tips on the next slide here. Again, if your business has losses, ensure you're aware of the various ways that the deductibility of those losses in 25 may be limited, and assess potential strategies to mitigate. And again, reach out to your CSH advisor to discuss. Moving on to number 9 here, tax deferral and income shifting strategies to consider in your business. First, I'll make the note that this should be a multi-year strategy, meaning that you'll want to evaluate what is your current tax rate and what do you expect it to be in 26. So traditional tax planning is going to accelerate deductions into 25 and defer income into 26. And this strategy works well if you expect to be taxed at a lower or the same tax rate in 26 when compared to 25. So a couple strategies to consider: evaluating your receivables and/or your inventory to generate a tax deduction for either uncollectible receivables or worthless or subnormal inventory. So in order to do this, you're going to want to review your AR ledger and identify those specific receivables which are uncollectible. And then by using that specific identification method, you will be able to determine which specific customers to write off in 25 as uncollectible. And then the same type of process can be used to write off worthless or subnormal inventory for tax purposes. Again, you have to use that specific identification method for tax. Year-end bonuses, another strategy you may want to consider is accelerating the payment of your year-end bonuses. You may want to pay those bonuses in December if you are a cash basis taxpayer in order to get the deduction in 25. Conversely, if you are an accrual basis taxpayer, be aware of the 2.5 month rule, which means that calendar year accrual basis taxpayers will generally have until March 15th of 26 to pay those bonuses and still deduct them in 25. You will want to be aware of the special rules for S corporation owners and bonuses. No matter what accounting method is used, corporation is not going to be able to deduct those bonuses until the compensation is included in the owner's income. You may also want to take a look at LIFO, which may provide a tax deferral if costs of your inventory are rising significantly. You also might want to take a look at accrued liabilities on your balance sheet to see if there's an opportunity to accelerate those payments. Again, this is the 2.5 month rule for recurring expenses, meaning that if you paid by March 15th of 26, you can deduct those in 25, assuming it's not going to a related party. Also, retirement plans is another way to reduce your overall taxable income. There may be an opportunity to establish a retirement plan before year-end 25 and not fund those contributions until the filing of your tax return in 26, including extensions, and still get that deduction on your 25 tax return. On the next slide, some planning tips. Basically, just take a critical look at your balance sheet at year end and assess any adjustments that might be needed before year end. So with that, we will turn it over to Brendan for number 10.
Yeah, thanks, Brittany. Last but not least, number 10, green energy incentives. So Zach kind of touched on this in the beginning in his legislative update, but I think it's important to think about what's happened just in the past 3 or 4 years in the green energy arena. You know, the Inflation Reduction Act of 2022 greatly expanded green energy incentives, both in scope and value to owners. Almost 2/3 of that law was actually green energy incentives of the Inflation Reduction Act. So quite significant. And then the One Big Beautiful Bill that was passed earlier this year really curbed a number of those incentives, eliminated some of those incentives. So we kind of had a 180 on the green energy front. But there are a couple of incentives that businesses can take advantage of for 2025 and can take advantage of for 2026 as well. And I think a lot of our clients are taking advantage of these and want to mention these two here. The first is the 179D energy efficient commercial building deduction. So that is a federal tax deduction available when you construct or renovate a commercial building. So it's a per square foot deduction that for 2025 starts at 58 cents a square foot, but can go up to $5.81 a square foot, depending on some different factors, primarily whether or not you're paying prevailing wages to the contractors on that project. But this is really a fantastic incentive, especially for architects and designers. And you can see there, it's important to distinguish between public or NFP projects and private projects. So on private projects, the owner takes the deduction. So that's the property owner takes that 179D deduction. Again, it's a per square foot deduction. So if you spend or if you have $100,000 square foot building that you constructed, and you max out that deduction, you get $581,000 deduction on that building. So that's great. However, you do have to reduce the basis of that building by the amount of that deduction. So you have to reduce the depreciable basis of the building by that $581,000. So at the end of the day, what that means is that the 179D deduction on private projects really functions like 100% bonus depreciation. So you're accelerating deductions into the short term that you would otherwise have to wait, over the life of the building to take those deductions. However, on the public or NFP side, so if you have if a government entity such as a school or a municipality has constructed a new building or any type of NFP has constructed a new building. Of course, they can't take the deduction as non-tax paying entities, but they can assign that deduction to the architect or designer of record. And that firm that did the design work for that project can take the deduction. And for them, there is no basis offset because they don't actually own the asset, so there's no basis to reduce. So it is all new deductions without any offset. So it's much more beneficial on that side. So certainly the planning opportunity here is if it is a private project, certainly you want to take a look at it and see if it does make sense to take 179D. If it's a public project, virtually all of those projects are going to make sense to take 179D on. And again, it's the architect or designer that would be taking that deduction. Just a note from a timing standpoint, and this was a new rule that was passed under the One Big Beautiful Bill, is that you do have to begin construction by June 30th of 26. Now, when you complete construction, doesn't really matter. As long as you begin construction by June 30th of 26, if you complete construction in 26, then you could take the deduction in 26. If you complete construction in 27, you could take the deduction in 27 or any future tax year. So again, the key date there is that construction has to begin by June 30th of next year. So the other, if you could go back one slide real quick, the other green energy incentive I wanted to mention is that Section 48 primarily solar credit is what most of our clients are using here. Some that install geothermal systems are eligible to take this credit, and there's other types of green energy production equipment that's eligible, but these are the most common, the solar and geothermal. Now, this is a credit, okay, so it's better than a deduction, and it can be up to 70% of your project cost. So if you spend $100,000 on new solar panels, you could get up to a $70,000 credit for the installation of those solar panels. So that credit percentage can vary greatly. It starts at 6%, but like I said, goes up to 70%. I would say most of the projects we're seeing are falling somewhere in that 30 to 50% range, not seeing very many below 30%, but also not seeing many that are above 50%. There are different ways to get above 50%, but it takes a very unique set of circumstances. But a couple of very important things I want to mention on these solar credits that we need to keep in mind. We can actually sell these credits. Again, this would be for private projects. So for tax-paying entities, you can sell these credits now. Typically, we're seeing anywhere from 91, 93 cents on the dollar is what people are getting for these credits. So if you're in a situation where you don't have taxable income that year, so you wouldn't be able to necessarily monetize the credits that year, you can sell them. And again, you take a little bit of a haircut, you take a 7 to 9% haircut, but you get the cash right away. So that's something to keep in mind there. Another very important thing for not-for-profit projects, on these solar credits is that NFPs can now get direct pay from the IRS for the amount of this credit. Again, they're not tax-paying entities, so historically they haven't been able to take advantage of these types of incentives, but they can now get direct pay, which is essentially, there's an application process, and at the end of that process, the IRS sends you a check for the amount of that credit. So you get to monetize that credit now. So that's a nice change on the NFP front. Ethan, can you flip forward to the next slide, please? Thank you. So just to summarize on the green energy front, again, as you saw with both of those incentives, project timelines are very important. So keep in mind when you're beginning construction, and for each of those incentives, how beginning construction is defined is unique. Okay, so if you have questions about that and are potentially kind of on the fence with meeting that deadline, please reach out to us and we can help guide you to make sure that you meet that cutoff for that definition of beginning construction. Goes without saying that the earlier you're able to secure these credits or deductions and get them certified, the better. That certainly is beneficial from a planning standpoint. And then certainly if you're looking at new projects where you haven't begun construction yet, I would strongly encourage everyone to factor these in and consider how they could impact your project. If let's say, for example, if you are considering installing solar panels and can get a 50% credit, for the installation of those solar panels, of course, that has a tremendous impact on the affordability of that installation. So make sure you keep that in mind. So with that being said, we are right at the end of our hour. We're at the top of the hour now. We did have a couple of additional considerations, a couple of additional slides, but considering that we're out of time, we won't be able to touch on those, but everyone's going to get a copy of this slide deck. And those additional slides are going to touch on topics like business succession and transition planning and year-end reporting compliance. So as you review those, and if you have any questions that come up, again, please feel free to reach out to us. So we have our final polling question here. Everybody can go ahead and answer that as it pops up. So we didn't have enough time to get through to any of the Q&A, but I did want to just provide a quick reminder of another webinar that we have upcoming in January. So this is going to be hosted by Phil Hurak, who is of course on this webinar as well. But this will revolve around our advisory practice, and it's going to discuss everything from AI to cybersecurity to technology innovation, and a lot of other topics. So would strongly encourage everyone here to register for that webinar. Again, that's going to be on January 27th. With that being said, it is 2:00. So I want to again thank everybody for attending the webinar, thank all of our presenters, and hope everyone has a great afternoon and a wonderful holiday season. Thank you.